A very good morning, ladies and gentlemen. It is encouraging to see that we've got a fair amount of you still here in this auditorium. Today's panel discussion is in part a follow-through of the presentation done by the two speakers earlier, Rob Curtis and Bernard Yap. So I believe some of you may have some pressing questions to ask. And in addition to that, we have Doreen Fadli, the Head of Business Policy of Labuan FSA, on this panel here as well. And essentially, this panel is largely to discuss captive developments in Asia, the global landscape post-COVID, key growth industries, emerging risks and regulatory developments within the industry, and top trends in captives. I have some questions that I would like to pose to the panel, but we are hoping that members of the floor can make use of the Slido app and present your questions there, and it'll appear in front of me here after it's been vetted by the guys at Labuan IBFC, and then I'll take questions. So far, I've only got one question here, so I would urge you to, if you have not downloaded the Slido app, please do so now. And the reference number, I think, is ACC 2022. And we will hopefully get your questions coming in. We have a question here, a first question here, and I thought that it would be useful if we were to take that question on the Slido. And I believe that question would be for Bernard. I'm not sure whether Bernard can see it because you don't have it there. But it talks about what's the captive tax rate in other domiciles, like Bermuda, and will they suffer like us in Labuan after BEPS? I like the word suffer.
Thanks, Roy. If I'm not mistaken, Bermuda, BVI, Cayman should be at 0% tax rate. Whether they are imposing a lot more substance requirements in the next couple of years. But at Labuan, we've done it much earlier because of the fact that we want to make sure that Malaysia continues to be able to maintain a lot of the tax treaties with their counterparties. So one of the biggest challenge when you do not adhere to the recommendation from OECD to put more substance and to increase the tax rates, then the tax treaties will not be renewed or will not be in your favor. But then I guess if you're quoting Bermuda, I've got a fellow colleague from another Big Four. He will be able to help me out as well. I don't think there's a lot of tax treaties being signed with Bermuda. So I don't think Bermuda is, in my layman term, going to give a shit whether they're going to impact me or not, because they're going to protect their own turf. They've got a lot more offshore entities there, and the fact that they don't sign any tax treaties with any countries, they're not impacted by OECD. They could be one of the four who did not sign up with the letter of commitment with OECD.
Thank you for that honest response, Bernard. We have also a question here from Nick Garrity. I'll be asking for some comments from our panel, but I thought I'd just clear the questions as they come. So I'm just keeping it informal, and I hope you don't mind. How much will the availability of the right talent limit the growth of the captive sector in Malaysia, and what specific talent gaps are there? If I could invite Rob to talk about it, because I think that was a topic or a subject in your presentation.
Thanks, Roy. I would say that is an interesting question from the perspective of, we've seen this play out in other markets, where you could say that it's analogous to Labuan and what they're experiencing as well. And I think it's a process of using the local talent that is there, and it's a matter of over time increasing the training and the support for the locals in particular of a particular market, so for Labuan. Because, you know, these new approaches and the supervisors were alluding, you know, very much that they will have to introduce some of these international standards. You know, they don't really have a choice. This is something that they sign up to as good, you know, international standard setters. And so they're expected also to, you know, roll out, if you like, and be consistent with those international standards. And that is particularly, if you like, focused around very much risk and capital elements. And so around enterprise risk management, the own risk and solvency assessment, the ORSA, and around, you know, as I mentioned, the increasing sophistication of capital management requirements. And the captives are not going to be immune to that general process where the supervisors will expect greater, if you like, sophistication and granularity around some of those aspects. So then you say, well, it can't magically happen overnight because it's you know, if you have a regime that is not necessarily used to that sort of level of granularity or detail on some of those aspects, then there has to be a pragmatic way forward. And often the way to do that is to set in place a dedicated, you know, process of upskilling of the local talent. And sometimes invariably you do get, you know, new people will come in to those markets, but invariably it's mainly one of education and training of locals as well, in terms of the enhancing their, you know, skill sets and their capabilities to take account of some of these more sophisticated aspects. And then there's also what we found worked well when I was a previous incarnations supervisor, is very much in some of the emerging and developing markets, particularly, is leveraging off, you know, some of the established service providers, for example. And so what you would find is some of the supervisors or the associations within those markets would utilize those, if you like, training resources and other experts from other services. And you'd have lots of, say, information training sessions or seminars, and progressively, you know, there is a development process which allows, you know, more and more people locally to then understand what is really the basis of some of these new techniques. And so the ORSA is a classic example. You know, if you introduce the own risk and solvency assessment to a market that's never really had to deal with this, then you do need the time to basically train up those people. And so I would expect, you know, that would be something that would be a little bit of a journey for Labuan as well. But there's clever and smart ways that you can also do that, you know, around to assist. And, well, if I give ourselves a plug, for example, but, you know, utilising something like AM Best, you know, we're not advisors, and we can't advise anyone, but we certainly, because of our rating and what we do, and we have clear separation in that. But of course, we have an enormous amount of depth in terms of knowledge and research and technical capability, which of course, you know, is there to be, you know, can be utilised to help inform and upskill. So, you know, these are sort of just some of the more practical elements which come into play.
Okay, thank you very much, Rob. I have a couple of questions that I would like to ask Doreen, and this is as a follow-up with regards to DG's presentation. And I think it'll be interesting for me to ask the regulator a couple of questions. The first thing that I have here is what are the performance of, or what is the performance of Labuan captive industry and emerging risks and regulatory developments within the industry in Labuan? So what's your take? Or what have you seen in that score?
All right, thank you, Roy. I think our DG Nick and Dato' Iskandar have explained a lot the performance of the captive insurance industries. As we can see, for the past 5 years, the numbers is increasing from 40 that we have now to 2022, we have 60 captive insurers. The premiums is also increasing. The trends are increasing, where we can see that the total gross premiums is surpassing $500 million in 2022, where captive is actually the second largest premiums contributor for the total insurance industries in Labuan. The third points I would like to raise, maybe it would be something that we can discuss further with our IRB and MOF, especially when Bernard mentioned just now on the BAPS 2.0. Last time we always brought that Labuan focus is always out international market. More than 60% of the business is actually from outside Malaysia, it's not in Malaysia. And the country that actually contribute the most of the premiums for the captive is Japan. Second is Indonesia, and third is surprisingly is UK. So, you know, when Bernard said that, yes, they come here to set up captive because we have full structures, comprehensive structures, I can say. That's why they come here to restructure the captive for their insurance arrangement. But then definitely there will be, you know, close engagement to see whether is there any effects to the captive when we introduce BAPS 2.0, because Labuan is always part of Malaysia. We can't have our own tax regime. Other than that, on the regulatory updates, I think DG Nick has mentioned what the regulatory requirements for captive, especially for PCC, which has been introduced, and also the regulatory capital control. On the supervision's approach, it is consistent with what Rob has mentioned just now, what our supervisors are looking at, especially on the, you know, it's no longer capital management, capital control. There will be other focus areas in terms of the conduct, transparencies, you know, in Labuan there are different types of structures, then the supervisions will be varies from each structures to other structures. So I think most of it has been covered by DG Nick and Dato' Iskandar, so I think that's a little bit of updates from me. Thanks, Roy.
Good, that's reassuring. Now, as a follow-up on that, I know that Labuan IBFC has a strategic roadmap for 2022 and 2026. And you know, I know the roadmap booklet has been out for some time, but most of us have not read it page to page yet. But for the benefit of the captive audience here, you know, one of the plans that the regulated Labuan IBFC have for the Labuan captive industry moving forward, notwithstanding all the challenges that we are facing.
Okay, so our roadmap is, you know, insurance is our main focus. As captive is a niche market, we want to go all out for captive for the next 5 years. In the roadmap, I think it's very brief, where we have, you know, 3 pillars, I can say 3 pillars. We focus on the business stream, the regulatory stream, of course, the enablers to enable how we want to carry out that initiatives. So here, I think I will focus on the business stream because the regulatory will comes together when we expand the scope of business. So under the business stream, of course, we want to focus on the rationalizing our captive framework that we have. Not that I can say that our captive is outdated or what. I think our captives are there, all the structures are there. If you benchmark with other jurisdictions, we actually offer various types of structures. But something maybe that's not clear. I mean, some of the potential, maybe they did not see the utilizations of the captive that we have in Labuan. So we want to give a better clarity. That's why we plan to rationalize, have an omnibus framework for our captive. Plus that, we have also, looking at the risks that we have, emerging risks, new set of risks. People always said that new risks, cryptocurrency risks, ESG risks, cyber risks, which is already there, but underserved or unserved risks. So we also look at it, how the captive can be, structured to cater for this type of risks or insurance gaps that we have. Next, that we would like also to look at is the, how we can complement ourselves to the Malaysian market. Okay, you see that last year there's unprecedented disasters happened in Malaysia, and we made to understand that such disaster, they don't have any insufficient cover, or some of the households don't even have any insurance cover. So, we are part of Malaysia. Labuan is not a different country, although we live in an island, we are still part of Malaysia. So we want to, like DG Nick mentions, we engage our Malaysian's government to see how best that captive, can facilitate. Even constant and frequent engagement with the domestic authority. When we're coming up with this strategic roadmap, we have already identified the areas that we want to focus and complement Malaysia in any ways where there's not available in Malaysia. Labuan can be there to support. We have a lot of, our intermediaries, our experts in Labuan, so we want to do that. Other than that, maybe I can share on the upscaling the role and professionalism of insurance intermediations. I think one of the questions is you look at the expert. So here, the captive is driven by, the intermediaries, the managers, the brokers. So we want to upscale the professionalism. Of course, there are various of policy guidance, I can say, to see how best that we can, upscale their knowledge and skills, especially to provide such services to the captive. I think that the next strategy is, of course, the promotional. When we have a lot of policies, but it doesn't reach to the desired people, then the policy will not be useful. So promotional activity, we work together with the LIIA, the marketing arm, of course, to reach our target market. And I think, lastly, of course, to work with and engage closely with the MOF and IRB, especially when we want to come up with the BAPS 2.0, we want to make sure that, it does not affect the captive that we have, the beauty, like the features of the captive that we have when you implement the BAPS 2.0, that everything need to be, carried out. So the next 5 years, there's a lot of things to be done, and it will not be like carved in stone. We always have the LIIA, the captive subcommittee, and the LIIA, industrial experts. We always open, like DG said, we always open for recommendations. We always look for any innovations that we can do in Labuan. As I said, what are the main drivers of other jurisdictions that we can, see whether it suited for Labuan business. Yeah, thank you.
Great. Yeah, to echo your last point, the LIIA has a captive subcommittee, and that subcommittee is populated by practitioners, be they managers or captive owners, or even reinsurers or brokers. And it's a large subcommittee that we use as a sounding board to get feedback from them. And the members in that subcommittee are not only looking at this region, but also a global perspective. So this subcommittee brings a global perspective, a global point of view, and a regional perspective to the LII, to which then we have a dialogue with Labuan FSA. So we hope that whatever roadmap that they have, which I'm glad to hear is not carved in stone, so to speak, but it's hard to believe a regulator that says that, but never mind. We'll give you the benefit of the doubt. That's me being cheeky at my expense. But there is, I know in the next 5 years, we have a host of challenges, and I know Rob's and Bernard's presentation as well highlighted those challenges that are going to come. So it's going to be an exciting 5 years, to say the least. For some of us. Now, I see that we've got more questions coming in on the Slido, and let's deal with them. And the first one on top is from ESG perspective. What is the level of expectation from AM Best to the captives? Any sharing how the ESG practices evolve within captives? Rob?
Yeah, thanks, Roy. With our credit rating methodology, we've explicitly integrated different considerations of ESG factors now into and alongside the traditional financial factors into the credit rating methodology. And a lot of these factors are not necessarily new. They're just been, if you like, better targeted and focused now on some of those ESG perspectives. So, if you look at balance sheet strength, clearly climate risk is now part of those considerations, and particularly the ESG focus around the investing activities of the captive, and this is very much a global phenomenon as well in terms of shareholder activism. And investor activism around the quality and if you like the green credentials of those investments. So that has been very much a focus that you're seeing on a global level, and that has now also been incorporated within the methodology itself as a consideration. So, and it depends on what sort of different organisations you're necessarily looking at, but your considerations around energy use, for example, or pollution, resource use, waste management, all of those sorts of considerations factor into that climate risk perspective. So it's looking at those, any stranded assets, that sort of aspect is what we're really looking at in terms of the balance sheet strength. That's then supported by the other key aspect of the methodology, which is around very much the operating performance. And one of the key inclusions we've now added is around social inflation. So this is a growing phenomenon that we're seeing as well globally in terms of the increased litigation which is occurring, particularly for, say, in the States. That's an issue, and the increasing claims costs are rising from social inflation. And of course that's also very much looking at, but not just necessarily an area around the States. It's also in other markets and countries where we're seeing that phenomenon increase. So this sort of ESG related litigation is something that is interesting that we're now also including. And so it's the impact of the ESG integration on profitability, if you like, and how does that flow through and consider the operating performance, if you like, or impact on those aspects. That's coupled with the business profile, and that remains largely unchanged. But that's a key overall factor as well in terms of what underwriting exclusions are there, the changing demographics, the data privacy issues, reputational risks. So that is still a key fundamental part of it. And then in the ERM module of the rating methodology itself, we've now included, specifically aspects of ESG relatedness around corporate governance. So this is really around the processes and the procedures and how a captive is effectively directed and controlled, around good corporate governance aspects to do with ESG, particularly combining that with some of the stress testing around some of those factors, and how is that incorporated in the total, if you like, risk assessment of the captive. And so that's coupled with, that broader financial and non-financial risk assessment, if you like. So it's not necessarily just any one factor. It's a number of considerations which have now been embedded, if you like, into the rating methodology that accompanies all of the stock standard, aspects that we've always had.
Right, thank you. I mean, someone commented that ESG is, there are too many abbreviations for ESG to be effective at all. There are just too many high important words there to deal all at the same time, so it's quite a challenge. I'm curious with Labuan FSA, has Labuan FSA come out with any policy guideline and so forth yet pertaining to ESG to guide the members?
At this moment, no, Roy. But then it's part of the roadmap also. We are looking at the ESG both in a business perspective and also organizational perspective. So we are carrying out, engage with how Bank Negara and SC is doing that. So yes, there is a plan to see how, because when we met with Bank Negara, we have to understand that what do we want if we impose this kind of ESG requirements? Because if, like, for example, the banks, there are branches in Labuan, so definitely they're going to follow what the head office is doing. So, a lot of considerations have to be looked at if we want to come up with our own initiative for ESG for Labuan industry players.
Okay, great, thank you. Bernard, looks like you are a very popular man.
Yes.
Looking at the questions that we get, so let's tick them off and see how we go. The first one is tax rates aside. What are the main drivers, captive growth in other jurisdictions, and how can Labuan emulate these drivers? So I would give this to Bernard and Rob, but Bernard, you may want to take a stab at this first.
It's a good point. I guess tax is not always the main driving factor, like I said earlier, for captive to be considering it. I guess the other part of it is also, the infrastructure. Rob talks about the human capital and the talent that is required. I guess those are the other stuff that is very important. And as what the authorities have been saying, we've got to be mindful that, Labuan is not a standalone jurisdiction on its own. Here we then use the complementary from Malaysia, the overall Malaysia, to be able to support the agenda and the policies in Labuan for it to grow. So this to me is more important. We're mindful that yes, way back in 1990, the original objective of setting up Labuan has got its own objective and agenda, but today, where we're in 2022, where are we today? We need to evaluate how, from my perspective, is how Labuan can work with the overall Malaysia, because the overall Malaysia has its own infrastructure and own things in place to be able to support Labuan. So example would be, I guess we, LFSA in the past have already allowed setting up marketing offices in Kuala Lumpur and JB as a way to complement Labuan, because this is where we want them to be able to reach out to whoever the stakeholders is. So I guess if we play along the same framework that Malaysia can complement it, then obviously from there it's easier to get talent, it's easier to push the infrastructure in terms of logistics as well, in terms of telcos and everything, for them to be able to operate in a seamless manner, not necessarily in the olden, I won't say olden days, in the 90s where we started with the fact that we need to be based out of Labuan. So with digital, with technology and everything in place, I think we need to embrace that to bring how the operating framework of Labuan should go along with times have changed today. And so that's the first part. I guess the other part is then, if you look at other regulators, other authorities around the world, tax is not the driving factor. There's a lot more other opportunities for us to be able to learn from it. Is like, how do we then train our people? Where do we use our education system to be able to accommodate and push through to make sure that they're able to support Labuan? Are there training grants that we can afford to make sure that when captive relocate to Malaysia, we have the talent and everything to support them? So we just have to now think more alongside with other regulators, not just in Malaysia. We've got, you got examples of MIDA, MDAC, and others, but also in terms of IRAS in Singapore and in Hong Kong, their tax authorities and their FDI agency. They do a lot more different areas, like I said, not tax-related areas that they can accommodate. But again, it's very different. Like I said, cost of office is expensive. It's a different focus from those countries. We don't have to worry about it because, we've got a lot of that kind of office space. But we need to think. We need to think out loud. Malaysia, I believe, can complement the growth of Labuan. And if we can think along that line, then let's use this to our advantage, because the other two jurisdictions I've shared in my slides are also small islands, if I can put it that way.
Thank you, Bernard. Rob, anything to add to what Bernard had said?
Well, I think Bernard touched on a number of elements which I would absolutely agree with, and look, clearly tax considerations are usually a primary driver. But as the question was asking, aside from that, what else? And it's absolutely critical, I think, that the regulatory infrastructure and support is, absolutely pragmatic, if you like, to the captive infrastructure, if you like. Because as a former regulator, the captives are going to be different. They have a different business model. Their structure is different. But as Doreen's saying, there's a lot of commonality, though, nonetheless, that you want to see a good captive have vis-a-vis its commercial peers. So very much, having the if you like, an agile and pragmatic supervisory structure is key to that. And actually having the regulatory framework which is supporting a captive industry, goes a long way, to doing that, in addition to, say, some of the tax incentives that might be encouraged. So that sort of, is necessary for any real, if you like, growth. Because people will want to go where there is a sensible, pragmatic oversight regime, rather than something which is obviously, because otherwise it starts to defeat the purpose of creating a captive. So, but having said that, you have to get the balance right, and it's not as though the supervisors can just allow anything to happen. It's not unregulated in that sense, but you do need a very good sense of pragmatism around what some of those risk and capital requirements would be. And I think Labuan certainly has that, and that's a credit to the local regulators. And one other aspect I think would add to that is, even having a captive market rated. Now you might say, well, you would say that, wouldn't you, being from AM Best? But in all seriousness, that provides, external stakeholders, reinsurers, with the added, knowledge and understanding of how that particular captive, for example, or captives in that market might actually be in terms of their performance. And particularly around, it's not so much a solvency aspect per se, because of the different nature, again, of the captive industry, but more around, the governance and the controls and the management of that. And that's analogous to the managing agents assessment, which we're now starting to roll out as well. And so, that in a sense also provides, a region or a market where if you have that level of ratedness in that sense. It actually also projects to others that this is a place which is, a good basis in which to locate and operate from.
I can echo the fact that Labuan FSA, working together with the LIIA, strives to see how we can make Labuan an attractive place to do business and to set up captives. And I think that's an ongoing process. Take your phrase, it's not cast in stone. It's something that we are constantly working at it in that sense.
If I may add, Roy, like what Rob's saying, that, globally, there's always opportunities, like other jurisdictions are looking at, by putting third-party risks in their own captive. We are looking at it, but at the end of the day, we have to look at that. As a regulator, we have to make sure we have check and balance. Yes, we want to expand the business as much as possible, but at the same time, the regulations must come together to ensure that, the utilizations of captive will not be beyond what is it supposed to be. But nevertheless, because other jurisdictions doing it with limited proportions of allowing third-party risk, or I can say indirect insurable risk to the captive, it must come together with a control behind it, so that we don't want our captive to be utilized for commercial insurer per se, because we always have another license of commercial insurer that can do that. So that's my comment on that.
Thank you, Doreen. So let's now look at Joshua Yong's question. As BEPS focus on cross-border businesses, as BEPS focuses on cross-border business, what's the panel's view if MOF will impose 15% on Labuan captives that primarily insure Malaysian risks? I think Bernard has that view and he said it, but just to be sure, Bernard?
I think like I said, we got to go back to the original objectives of Labuan, and BEPS is consistent on it. The main objective was to make sure that we were able to attract the FDIs to be based out of Labuan. Labuan was never meant with the intention of having Malaysian local companies setting it up there in a so-called way that they were already doing international trades or whatever, and then enjoy the 3%. I for one, would support the tax authorities that if Malaysian entities have abused Labuan and set it up for their own purpose, for their offshore, then I guess not 15%. They should be paying back to the normal corporate tax rate at 24%. Then realigning back to that objective, I think if we're successful in attracting the FDIs coming in, the foreign captives to be based out of Labuan, how do we then ensure that their agenda and their objective is protected, because they are relocating and moving from overseas to Labuan to serve their own group requirements, and that's a part. But aligning back to today, and that was 1990, aligning back to today with OECD guidelines and everything, that they want to see through the entire supply chain globally, then the million-dollar question is, how does Ministry of Finance in Malaysia wants to protect what the original agenda for Labuan vis-a-vis to what OECD wants us to do from a global perspective? I think that's the hard part, not only in Malaysia vis-a-vis to Labuan, but all countries, 137 countries. They have to think about their strategy, their sovereign strategy in terms of attracting FDIs coming into their countries and aligning it to what OECD wants them to do. Malaysia is not the only country that has got this preferential jurisdiction. If you go to Dubai, you go to any other places, they have the same. Indonesia have their own special economic zone with holidays, tax holidays and everything. So how are we then going to move forward and protect that? Because the developing countries need these kind of framework to be successful in attracting the FDIs to their country. I think that's the hard part. While, like I said, 137 are committed, signed a letter of commitment to abide with OECD, how do they play with the rules within themselves? I think that's the biggest challenge. So for me, if it's addressing the issue of purely Malaysian entities setting up for their own purpose, I, for one, agree with the tax authorities. It should be at corporate tax rate on that. There's already framework in place that if you do business with Labuan for your own, you don't get a deduction in your own Malaysian tax returns. And I think that's fair. To me, literally, I think that's fair because the original objective is not meant for Malaysia. It's meant for FDIs coming into this, into Labuan.
Okay. If I may look at the next question, and it's just generally to the whole panel, and you may have different viewpoints. How do you see IFRS 17 impacting captives in the region, and maybe in Doreen's case, it'd be interesting to see how it's impacting captives in Labuan, and maybe Bernard could chime in on that, and Rob would probably comment from a regional perspective. So if I could invite Rob first to give us his comments on its impact in the region on captives.
Thanks, Roy. From a regional perspective, part of before coming to AM Best and before that at the Hong Kong Insurance Authority, I was responsible for the Asia Pacific risk approach we had at KPMG, and one of the busiest times we've had is on IFRS, or that the firm had at the time, and it's still obviously a lot of spend is being made, and that is now sort of coming off stream now that it's getting closer. But the amount of IT infrastructure and the data, it's essentially around Asia Pacific. There's been some very big investment made in a total revamp of all of the financial / accounting and data needs to accommodate some of the reporting changes and the capturing of just how the changes to sort of market consistency is coming through. So that from a pure consulting perspective, they I think consultants generally made some quite good revenue over the period assisting with IFRS programs, and many of the industry participants took the opportunity to really do a data transformation, IT transformation, overhaul, if you like, of their internal systems to accommodate that. So that was a very significant impact, I think, across for many Asia Pacific firms. The upside now is post the implementation of that work. They should now be one of the leading markets in the world, actually. But that did create a lot of resource implications as well for many firms across the region. And but better analysis is now starting to come through, which is consistent with those international norms. So that's an upside.
Okay, Bernard, do you have any thoughts from a Malaysian perspective with your clients?
17 was more of a global standard, more for a normal insurance company that deals with external retail or corporate customers, but captive being very unique for its own group. It's going to be an expensive, unfortunately, I'm going to say this, it's going to be an expensive way of implementing 17 for captive. But to me, on the flip side is that you have this in place, you meet the capital requirements, you satisfy the regulatory requirements and everything. I think that will add on more substance for you to be in compliance with whatever regulations and regulatory requirements in that jurisdiction. I think it helps push up the level of confidence, hopefully to the tax authorities and to MOF, that these are the additional substance that I have taken in order to operate and facilitate my captive business in that particular jurisdiction. So it's not just previously in the past, having a kind of very simple setup operations for captive in the jurisdiction. These additional regulatory requirements over the years, to me, it's good. To me, it's more to enhance that substance requirements. But like I said, unfortunately, then it is going to be an expensive measure because it's not easy and cheap to comply with it.
Doreen, has LFSA any comments on this?
Okay, with my limited knowledge, okay.
Yes.
But actually, IFRS 17 is quite a challenge, not only for captive, but the whole industries. But we look at, when in the roadmap, we are looking at proportionate regulations, because as Bernard said, captive is a unique structure. So we have to really look at whether it is, relevant or what. But after all, there is a compliance that we know, because that's the standards, but definitely we will look at the proportionalities of that regulations to our captive industries because of the structures. Yeah.
So it's not a must. It is a must.
It's a must now, yeah.
Okay, all right. The next question, I think it's for Doreen, largely. How is LFSA supporting Bank Negara's DITO framework in terms of captive formation?
Okay, this one, I can say that digital insurance and takaful operators, they are targeting, underserved market, those market which, that can't be reached. So we have various structures of captive, and again, come back to the Bernard's points that whether Malaysians risk as part of, but put that set aside, because Labuan here is to provide support for Malaysian market. We have various structures that we can say, group, associations, captive, that can be, structures in a way to provide support for that particular target market. But at the same time, maybe captive, because this is retail, I can say, maybe, Roy, this is more on retail market. Reinsurance support is always there.
Yeah.
In Labuan, what I can say, that's the things that.
Okay.
Yeah.
Fair. The next question is rating of captives. I would like to break this into two parts. I mean, has LFSA got any policy about captives being rated, or no? So, all right. So that takes care of that. So I think I take to the next question to Rob to say how critical it is for captives. I know your answer will be yes, it's very critical, but let's not assume you're going to say that. If one were to put on a practical hat, not all captives need to be rated. And why would a captive need to be rated? Of course, the answer to that is quite obvious, but if you could take it, Rob.
Well, of course, it depends on what the captive is involved in, and particularly the industry. And of course, some of these niche risks, are very complex, yeah? And that is one of the, main attractions of actually having a captive in the first place, is because sometimes accessing the reinsurance market to begin with, you may not necessarily understand some of those complexities, particularly some of the liability risks, or some of the bigger, larger pharmaceutical or industrial type risks, it can be challenging. Yeah? So for a lot of the groups, it's an attractive proposition to have, the captives. Now, without wanting to beat the drum too much, what it does practically show, though, if you have a captive that does get a rating, it actually is demonstrating that the captive management and the board of that group are really, very conscientious, serious, dedicated to ensuring that not only the financial condition, but also that, there's good governance, good systems, good controls. This is a well-managed captive. And that actually provides a tremendous fill-up for, the discussions with the reinsurers.
Yes.
Because, the reinsurers in turn, are wanting to see what other aspects or other perspectives may have been provided, for example. And that's the strength of where a rating can come in, because, you get the third-party independent view, which is not a regulatory view, it's not a consulting view, it's an independent view, lens over, the quality of that captive. So that allows, for example, one captive that is rated vis-a-vis another that isn't, to actually go to the reinsurers and say, look, we've put ourselves through a rigorous independent process, and here's our rating, actually. And that demonstrates and signals to the reinsurers quite a lot. Yeah.
Yeah.
And anecdotally, that obviously does come into the consideration factors of the overall reinsurance program that can then be derived. So that's a significant benefit. At a local supervisory level, obviously there would be tremendous benefit to be gained by having captives independently viewed. And going forward, for example, you could imagine, a situation where, for smaller captives, rather than the usual, say, international rating that might be applied or the methodology, there is, if you like, a captive insurance rating, which looks and takes account of the specificities of the captive market in general, the smaller captives, what they're dealing with. So that review wouldn't necessarily be around the financial condition or the solvency of the captive per se, although that obviously would be important. It would be, as Doreen was, been making, the comments about, its good governance, the systems, the controls, the ability of management to, be running a good, healthy captive. So I could imagine going forward that ratings itself may evolve, and adapt to.
You hope.
Because there is a need, yeah, I think, amongst some captive providers for that sort of external check.
I'm sure there are other rating agencies as well here in the room would share that optimism, to say the least. We have another 10 minutes left for this panel, so we've got 2 questions there, and I've got a few questions if time permits. The second question is for Mr. Rob. What is the determination for a company to set up captives in Asia Pac? Is it because of the availability of structures offered or due to tax benefits? I think we've answered some of it, but I think it's sort of a wrap up here as well, Rob, on that point.
Yeah, I would, without repeating what the panelists have said before necessarily, clearly, look, tax is a driver in many considerations, but I would actually say what's even more fundamentally critical for any consideration of domicile is actually the strength and the pragmatism of the local regulatory environment, because it really does need the local regulators with a mindset that they're to encourage and support a captive regime effectively. And there are many supervisors around the world who just wouldn't want to contemplate that because of various reasons, and that would be mainly because they're focused on other aspects of who's in their market, particularly say the larger international players, for example. So if you do have a particular supervisory jurisdiction or regime which is wanting to support and encourage and promote captives and the development of same, then that's absolutely fundamental. And then with all of that infrastructure comes the tax considerations, and then comes the more practical elements around as we've discussed, the risk and governance and those processes, and then really become more of a good governance type approach around systems and controls and management quality. So I think that's the sort of main drivers of where you may go in Asia Pacific.
Thank you, Rob. The last question there, I think, is Bernard. I think you've dealt with some of the points, but I think it wouldn't hurt to repeat some of it, especially with reference to however would OECD allow the top-up tax collected be retained in Malaysia. That's more of a crystal ball situation.
The fundamental principle is Malaysia should, if they do impose, then they should be the one retaining that one, the amount to be in Malaysia. Otherwise, then the tax jurisdiction on the holding co will then elect and say, my subsidiary will top it up in the home country if it was not paying the 50% tax. Then the question goes back to, if Malaysia wants to do such framework in place, how do we then work towards where a lot of countries today are actually having grants, subsidies, or whatever to facilitate back that particular FDI who is already been very supportive and operating in Malaysia. So that's one other way to work around it. Or two, the other one is then looking at if we don't do it, because if that's the case, then we look back at what's the economic contributions if we continue to have the 3%, while the group is still paying the 15% tax. Then if they are willing to retain and continue to be operating in Malaysia or in Labuan, then we have to evaluate what's the multiplier economic contribution back to this country. Because there's no way that we would have to have a situation where anyone is willing to pay additional taxes, if you compare to other jurisdictions, if it's lower, and continue to be here. It theoretically and fundamentally, it just doesn't work in that way. So we've always, in consultations with OECD, we've always said that when you look at this kind of framework in place, you got to look at other countries where they don't provide lower tax payments or schemes or incentives. They go back in the form of grants and anything else behind the scene. That still is a form of, preferential treatment to the taxpayers. So I guess we just now have to be thinking out of the box a bit in terms of where we are. But I know obviously from a country perspective today, giving grants is a bit challenging because, where we are in terms of the country's budget deficit and things like that, it's all different. Developed countries, they don't have budget deficit issues, so they can do with grants and everything. We can't, because as a developing country, we are in a different financial and economic status position vis-a-vis compared to developed countries. So I think we have to be mindful of that, because not all countries around that 137 list is having the same economic, political criteria that is consistent across all around the world.
I was about to ask you another follow-up question on that, but you've answered in part where the question is that, is Malaysia ready for BEPS? Will Malaysia be ready for BEPS, or we have no choice? We got to be ready no matter what. I know it's a tough one, but let it rip.
I think we're a country today, we have close to, if my last count, we have close to about 120 tax incentives ranging from manufacturing, agriculture, all the way to construction and all kind of industries. We've got every single regulator giving different kind of incentives. So whilst from a higher policy perspective, we need to realign our tax incentive framework, and Ministry of Finance have always wanted to do this as an agenda, but there's always challenges faced because it's a chicken and egg situation. If we don't have this in place, how do we then promote growth, getting FDIs coming in? That's number one. And then the continuous changes in the political scene, like I said, relocation of Chinese and other investors into Malaysia, then we have that challenge because it's continuous. Then the other part is the continuous growth in the ASEAN region. Vietnam, Thailand and all are also promoting their areas, their own economic zones. We cannot leave out, we cannot be left out from that perspective. So that's the first part. Are we willing to restructure or reduce our current very good long list of incentives for that purpose? And then number two, on this other side, if we don't comply with OECD, we implement partly whatever that we think it's not detrimental to Malaysia, we implement it. Whatever that we think it's going to be a big challenge for us, if we don't follow it, how do we then be perceived by the other OECD models, or OECD countries, when we renegotiate our tax treaties, our double taxation agreements? Because that's going to be their bargaining power when they go and negotiate treaties with us, right? Obviously, then the third one is we really need to think about what and where we are today, because we need to think Malaysia first, of what our current economic situation is. We really need to focus what is important for this country before we realign back to what OECD wants to do. And I think, I don't like to be in a position of Ministry of Finance. I'm not the one having sleepless nights to think about it, so I'll stop there for now.
Maybe you should. We have about 4 minutes left. I just want to pose one last question to Rob. The question being is that with all these challenges and opportunities that captives have in the region and being set up, are regulators keeping pace with these changes and these developments, and can they manage it?
Oh, that's a good question. I think the answer is yes, and it's a hard job being a supervisor as well, right? Because you're always trying to make an assessment independently without necessarily being part of, that entity, right? So you are looking at it from a third-party perspective, and you're trying to make a view. And so one of the reasons that when I was a supervisor and chairing the international committees and all of that, and Solvency II in London, we realised quite early on with all of that work that actually the way we were doing supervision actually was doing a disservice to the industry effectively, because we were looking very much always behind. So the annual returns were submitted. By the time, most of the supervisors got around to looking at them, the data was at least 6 to 12 months old. And we used to get nothing about how the entity was managing its risks, what its forward projections were, the financial condition going forward projected over 3 to 5 years. We used to get none of that. And so what we did was we effectively said we need to turn supervision upside down. And instead of always being behind the curve, we actually need to get in front of it. And the only way we can do that is by introducing new requirements effectively, which start to then say, look, insurer, we actually want you to tell us in advance what your financial condition is going to look like or projected to look like over the next 3-5 year period. We want you to do forward stress testing, now reverse stress testing type elements coming in. We've increased the capital sophistication around the modelling. So all of that sort of innovation, if you like, in supervision itself was to allow supervisors the ability to very much be armed with looking forward and having forward view judgments with firms rather than being reactive. And so when you look at basically where the industry is now and the regulators, there's a much more mature understanding of all of those dynamics. I think the industry initially, if you go back say 15 years ago, used to fight it quite a lot because they thought this was going to be a huge burden for them. And it's like, actually, this is good risk management. And if you're doing it for yourselves as for the board, because the board would expect it, and you're projecting forward your capital and financial condition, then actually you can share that with us as a supervisor, and that was the thought process at the time. And that still continues today, I think. And so the supervisors are able to have a much more intelligent discussion, I think, with whether it be captive management or, with say, a primary carrier or reinsurer around, what that looks like going forward and how they can, best then attune their supervisory, intensity to that particular entity.
Okay, well, thank you for that. I'm sure Doreen would agree that you guys are trying your best to stay ahead of the curve at all times. All right, guys, I think we've got 10 seconds left according to the clock, so we've kept it in time. First of all, I'd like to thank those who had submitted their questions. Thank you very much. They were very interesting, and I'm glad it posed a challenge to our panel members. I would like to thank our panel members, Doreen, Rob, and Bernard, for giving us this time and sharing their thoughts and comments and experiences to the floor. With that, ladies and gentlemen, I pass